This is Bloomberg Businessweek with Massar and Tim Stenovec on Bloomberg Radio.
I am so excited for our next segment because we get to talk about a dream that I think will never come true for me, which is owning a home in New York City.
Well, like a $7 or $10 million penthouse?
Right. I mean, I don't know. What am I going to do? Own like a weird studio? Like,
never know.
I'm going to be 40 someday and
You
I'm going to
never
be in
know.
a studio, you know? But Tim, to me, you embody the classics of the American dream. You've got the beautiful family. You've got a home that you're quick to remind me is an apartment.
It's an apartment.
So it doesn't count.
We're quickly outgrowing it.
Yes, as you've got another baby there. But here to help kind of potentially crush our anxiety levels when it comes to the real estate picture, or fuel them, who's to say, is Frances Katzen, agent with Douglas Elliman. Frances has $3 billion in total sales, selling in excess of $350 million annually. So a great pulse on the market, Frances. Thank you for coming in studio with us. Talk to me about the outlook in New York City. Is there any optimism for me out here?
Well, Madison, I think it depends on which side you're standing on. I mean, I think that the luxury sector, over 4 million, is having the most fun right now, to be candid, because there's the most opportunity. When there's this unknown variable, there's a lot more negotiability. They're a little bit less dependent on any rate. They're exempt from it, to be honest.
Because they're paying with cash?
Correct.
Yeah.
And just to be clear, the 65% more cash deals that we're seeing are not necessarily because there's more cash deals. It's just that the mortgage deals that were happening have slowed down. So those that 65% just looks front and center.
Like, it used to make sense, even if you had $7 million to spend on an apartment in cash, rates were so cheap, it used to make sense to actually take out a mortgage, because you could take out a mortgage for 2.5 to 3.5% and then throw that other money in the S&P 500 and, or do whatever you wanted with that other money. But now that's not the case.
So therefore, cash is king, because sellers are really wanting to take advantage of unloading the asset. They want to get out of New York, or they want to downsize, whatever it is. And this is the opportunity, because people have uncertainty. They're not sure. There's a malaise in the market. There's an unknown. Should I time it? But these ultra luxury buyers, there were 3 sales done over 50 million over the past week and a half. One in the West Village, one in Gramercy. It's happening. People are doing it big time on the 50 million plus. But it's the entry market that has the least to spend, the most to lose, and are the most impacted right now, in my opinion.
What does that even start to look like?
In what way?
Like, who can buy a home at the entry level right now?
So I think it's for parents who can help bankroll the down payment. Because that's the most illiquid part for these buyers. They can probably manage the mortgage and the common charges if they can make it work with the relationship of a lender that can give them a little bit, like a quarter or a half a point down. But at the end of the day, people are having to grieve and say goodbye to 2.75 to 3.5% rates and get ready to take 6.8 to 5% rates, which is meaningful when you're carrying a certain income and you're hoping not to rent because you want to own equity. It's hard.
Frances, I mean, we've been talking real estate a lot this afternoon, but I wonder about just the lack of supply that we're seeing right now, and if the story in New York is at all different than the story in other parts of the country. And I go back to what Fed Chair Jay Powell said about, and this is for starter homes. I mean, there's new construction coming online. There are new developments happening all over the country because there's demand for them. We just don't have the space here in New York. We're not going to be seeing Lennar come in and build a bunch of homes, for example.
So here's what we're seeing. We're seeing bidding wars up 7.4% around the country, but we're not necessarily seeing it in New York. But because there's a down of inventory, it's about 23% down on inventory for under 4 million. We're seeing that change in terms of bidding war for the under luxury price point. Around the country, you're right. There is a level of need and supply and demand. New York, you're right. It's not getting any larger. But the problem is that it's so expensive. People can't make the numbers work. So New Jersey, Brooklyn, Long Island City become very interesting because people want to save. They don't want to burn it all out. But at the end of the day, people like to park their cash in New York City. It's a hub.
What are you seeing when it comes to foreign buyers right now? Have they dried up?
Big time. No,
Big time, really?
No, it's happening. I'm doing deals with Germany, London, Russia. It's happening, yeah.
Russia?
Yes, yes.
Go into detail, please.
I can't. But suffice it to say, people want to get money out of certain countries and park it.
Yep.
And it's happening.
Yep.
It's happening with Asia. It's
Wait, so I just want to make sure we're allowed to do deals with Russia. How does that work?
I'm not discussing anything
Okay.
other than to say it's happening.
Okay.
That's
So,
it.
And how luxury are those deals?
We're talking 15 million plus.
Yeah.
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 There's a lot of discretionary income, but it's more than that. It's a hub. We have a very different tax allowance here than we do for the actual New Yorker.
Sure.
Go figure.
Yeah. What is that looking like in terms of the impact on availability of units for renters out there? Are we still seeing a lot of units that are sitting empty because...
So that's a really good question, because last year, in November, we had a vacancy rate less than 2.7%,
Wow.
and rentals were up 40%. Now we're seeing the rents softened in the early part of 2023 because we expected a big sale push, but because the rate started to really impact that, and the inventory was down because nobody wanted to let go of that really good rate that they had as a seller and have to take on almost double-digit carry, we sort of got back into the rental market. But the rental market went from 1 month OP again to now fully, no, we're not negotiating, but now again, it's measured because parents are coming in and
That is so
deployment
funny
of
to me.
foreign investment coming in to offset that.
I'm not a parent.
So the rental market's
that.
moody.
We have 30 seconds left, but common charges are the killer.
Yes.
I talked to somebody,
Yes.
a colleague
It's
who's
killing
trying
me.
to buy,
Yes.
and they just can't make the numbers work because
No.
of common charges.
But is it the common charges or is it the combination of the rate? Because the rate was so artificially low,
Yeah.
it offset the standard common charge of, $5,700 or $3,700, depending on the size,
Just
or
for
20.
the common charges.
Yeah.
Wow.
Common charges.
Maddie, are you optimistic?
I mean, it's not going to happen for me, I just
say
think
that.
okay, what's happening with rent really quickly? Is my rent going to get any better this year? Next
Depends.
year?
It depends
Year
on what
after?
happens with the rates. I think that quarter-point hike sort of really pushed things
Yeah.
over, even though inflation has steadily come down. So
Yeah.
I think the rental market will adjust
Yeah.
when we see rates adjust.
All right. Got to time the market, I guess, Tim.
Timing.
Frances Katzen from Douglas Elliman, really good to have you with us this afternoon. You're listening to Bloomberg.